Hey, what's up, guys? Welcome to the channel where we do all kinds of trading videos. Primarily, swing trading is what I'm into. I do a little bit of day trading, but mainly swing trading and learning into the futures market. Really trying to press heavily into futures because of the leveraged um, options there. So, I just want to make a quick video on the difference between uh, leveraged ETFs and futures. Got a text from my brother the other day that said, "Hey man, I see that you're avoiding um, leveraged ETFs such as like SPXS and SPXL," and he was wondering why I'm avoiding those. And to which my response was, I didn't really know about them. I wasn't really. It's the first I've heard about them, So I'm doing my research into those, and I figured I would provide my response via video. I already responded to him. But that being said, my initial overview of it was okay. Let's look it up. Um, so yeah, that's primarily the S. Looks like it stands for the smaller account, priced at 35, and then if you go to SPXL, okay, then you got the same exact thing. It's SPX, which is the S&P 500. Um, direction daily. So basically, it's times three multiplier on the direction of the S&P. So it's going to track the S&P 500. Um, Actually, I'm just now seeing that says bull and that says bear. So let's make sure these are going the same direction because they could be opposites. All right, we were on S. We go to L, and it says, okay, the L I assumed is larger, so that's 210, but let's make sure it's going the right direction as well. So yeah, it's not like a reversed. There are a couple funds out there that reverses the chart. It'll literally just flip it so that you can trade the inverse if you are interested in that. But yeah, this looks like it's just the fund size 210. So it's trading exactly like the S&P 500. Um, It looks like these are identical. I don't know why they have bull and bear, but if you go to SPXS, yep, that's what it is. Okay, so this would be, huh, wow. All right, me personally, I'm not really interested in doing this. Makes it kind of confusing. This is the inverse of the S&P. This is what I was talking about. If you're interested in just seeing the chart upside down, that's SPXS. I'm not interested in that at all because it's. I guess if you have a problem telling yourself to trade to buy a short because it's a negative position because the market's going down and you want to be able to see it going up instead, then you would enjoy this chart because it's reversed. Either way, I wouldn't be doing that. Uh, that's why that's considered bear, okay, because that's a bearish chart, and the XPXL is bullish, okay, that's why it has the bull there, and this is going to be mirroring the S&P chart. When you look these up on your phone, on the Robinhood mobile app, it does show as soon as you pop it up there. Warning: this is a inverse leverage product. All right, for XPSS, and then if you will go over to XPXL, and it doesn't say it's inversed, right? But you do get the warning label that says leveraged, right? All right, now to discuss sort of the difference between like leveraged ETF right here. You got times three versus the S&P, right, times five. So I'm gonna draw this out and see if we can explain this. All right. So here we have XPXL. The leveraged ETF and of the S&P, and then over here is the futures S&P MES. So some of the primary differences that I see is, all right, cost per share 209 ish right now is what we have under the SPXL. MES was $2,400 for a contract. Now it's like something like 2,600. So it kind of, it changes. We're going to put 2,600 up there for now. All right, and then the multiplier, of course, on the SPXL is let's see, times 3. Okay, and then MES multiplier for a micro contract. So this is the MES, not the mini. If you're trading minis, it looks like this. We're not trading the mini contracts. These are times 50 multiplier. So it's a different story. I trade the micros. Micros is a times 5 multiplier for every contract that you trade. So right now I'm in 3 contracts. That means I have a times 15 multiplier. Very important to know what your multiplier is, because and I don't mean just like per the position, but like it's important to know what your multiplier is overall, your whole account, because that's going to be how much money you could potentially make and how much you can lose. So you want to be on top of where your multiplier is for your whole account. So for instance, right now, my whole account, I have 3 MES contracts. So my multiplier is 15. So I calculate times 15, how much money that I have in there. If it were to drop 20% on the market, say there's some crash or another war breaks out right now, and it goes all the way, we're down 10% right now, it goes down another 10%, I can buy that back and continue to grow. So it's very important to know that, okay, times 15 is as much as I can handle. So obviously, you can look at this, and I'm going to delete this so that it's not distracting. And then you can obviously look at this and say, oh, wow, my cost per share is way less with SPXL. So therefore, I can afford a lot more, which is great. Yeah, I could definitely do more of these and be at a higher multiplier for the same cost than over here. And I actually did, whenever I responded to my brother, I actually went ahead and did the math. I'll just do it real quick. We'll do 2,600 divided by 209, and that's 12. So I can get for $2,600, I could have 12 of these. So you say to yourself, oh wow, that's fantastic. 12 to 1 ratio. And that's the easy way or that's probably the first thing that's going to be in your mind to judge, like, oh, wow, this is way better, right? So you got to think that does improve your cost ratio. You can afford a lot more, but it's also increasing this multiplier a lot. So what you got to keep in mind is that 12 times 3, 36. I should have done that in my head. So if you have 12 shares of this, now your multiplier is 36. So just because you can afford 12 of these doesn't mean that you should buy 12 of these, because a times 36 multiplier, like, yeah, if you're a risky person and you enjoy gambling, times 36, like, yeah, you might make a killing off of that, off of a rise. Like if you just jump on a green run and climb it times 36, that's, more power to you. But the minute that you do that and something switches on you and you have a big red downside, like, say we blow up an oil rig, yeah, this is going to eat you alive and it might bankrupt you. So just because you can afford 12 of these doesn't mean you should. Like I kind of was mentioning earlier, it's very important to know your whole risk multiplier for your account and what you can afford to lose. So mine account currently, right now, I have a times 15. When I look at the MES chart, I calculate times 15, which is 3 contracts. I don't want any more than 3 contracts. So over here, to make this, let's just title this like risk assessment. Yes, 2 S's. So like to bring the SPXL down to the risk assessment that would match this over here would mean you would have to lower this number of this quantity of shares. So half of this, 6 shares would be 18. So you got a little bit more to go. Multiplier 3. So if you had 5 shares, I think that would be 5. So if you had 5 shares of SPXL times 3, then you would be looking at the times 15 that I would need, okay, to be in my safer zone. That way, if it depletes the account 20%, then I can buy back. Now that kind of raises the question why you would need to buy it back. So MES has an expiration date. It expires and you have to roll over the contract. So you have to be able to sell it before or at expiration and then buy it on the next side and let it climb. So that's part of the theory behind needing to be able to buy it back. Over here, since this is an ETF, it doesn't expire. It's just like a stock. You don't really have the need to buy it back. But you do need to be able to ride it into the negative as far as your maintenance requirement. So if you're on a margin account, you have a maintenance requirement that you have to maintain. So it's nice to have a margin buffer, like a safe buffer to where it doesn't go down too far. That being said, SPXL is just because you think you can get 12, it's, I would ignore this column here and not do that. Too much risk. And then you could get into this right here. So it is a sound option. 209 times 5 would be 1,045. So doing this research, yes, this is a cheaper cost at the same multiplier than 2,600. So you would benefit on maybe doing 5 XPXL at $1,000 to get the same multiplier than to do futures for the times 15 multiplier. The only other thing that I see here that's going to make a difference is XPXL is just going to be a regular stock, so it's going to be taxed at a capital gains, short-term, long-term. It depends. If you hold it for a year, great, you get the long-term advantage. I think it's if you're in the lower tax bracket, which most of us are, right? I'm just assuming, and you get and you hold this for a year, you're going to get that 0% long-term trade. So 0% taxes on those gains if you hold it for the entire year, which is great. But my whole sort of goal with this is to uh, buy and sell on the lows and highs and try to make more a better average than the S&P, right? I'm trying to beat that. So if it averages 10% a year, I'm trying to get like 30%. Um, just as a random number to throw out there. So that being said, it's not going to be long term position. It's going to be a short term position. It's going to be taxed at a short term rate, which I believe it's roughly 12%. Let me fact check that. All right. So based on your income tax bracket, yeah, it's like 10% or 12% if you're in the next bracket. So yeah, you're gonna get every sale that you make over here, you're gonna get taxed at 10%. And that's kind of the key that comes in here is let's just go ahead and make another block tax. This is another like um, this is another comparison that's kind of comes into play here. You're gonna get let's just call it 10% because that's what it's gonna be for me. So if I sell this short term, it'll be a 10% tax. Futures trading is you got what is known as the 60-40 rule. So 60% of your capital gains when you make this sale is going to be taxed uh, at the long-term percentage, which is 0%. So over half of the gains that I get from futures taxed at 0%. So that's an advantage. 40% is going to be taxed at short term. So only 40% of this is going to be taxed, which is going to be at the 10% rate. So on this side, all of your gains is going to be taxed at 10%. Over here, only 40% of your gains will be taxed at 10%. So, where do I see like applying this to my strategy? Uh, it seems like this cost savings here is definitely worth it. That's $1,000 savings per contract, so that's like 3 grand to go over to here. But also, you have this tax advantage. So what what I'm sort of just spitballing here is like sort of a split, right? Like I might do um, only one or two micro contracts on the futures market, and then uh, start buying like one SPXL long term just to like hold. But honestly, like I just don't. I'm not really interested in this as much because of the taxes that are there, um, and because I'm interested in like watching the computer, being checking it daily, um, and buying and selling, buying low and selling high. So if you're more of like you have a good job, you're you know interested in just buying some stuff and letting it ride, and you're not going to sell this within the year, you're going to ride this to the long term, SPXL might be a better choice for you. Uh, Definitely cheaper. You could do these, and then you would have $1,000 extra per share from these to spend on other stocks or whatever. Um, Personally, I really like this 60-40 split on the taxes because am going to be trading throughout the year, buying and selling. So yeah, maybe a smart decision would be a mixture of both. Maybe like putting in one or two of these long and then trading daily on like maybe one micro contract, something like that. Best of both worlds. But this is pretty much my comparison of the two. I hope that you found that helpful. If you did, please subscribe to the channel. Comment any questions you may have. If you trade either of these, let me know your strategy. See if it lines up to anything that I just said here. Anyway, guys, appreciate you watching, and we'll see you on the next one.